This IFRS 15 lecture video, and now after this thing I'm just trying to make a quick summary for IFRS 15, what you are expected to know, what generally could trouble the students in exam. First thing is that you need to understand that there are 5 steps given in the standard. I'm not going to write those 5 steps, but I'll just speak them up. So step number 1 was that you identify the contract. And then step number 2 was identify the contract value overall. Then you identify the performance obligations within the contract. And then you assign the total contract value to different performance obligations. So 4 steps are done. Number 1, identify the contract. Number 2, identify the contract total value. Number 3, identify the performance obligations within the contract. Number 4, identify the value, assign the value to each performance obligation. And number 5th, the last one, is to recognize the revenue as each performance obligation is met. So recognize the revenue as each performance obligation is met. And we know that performance obligations could be point in time or it could be period of time. Point in time means that if you deliver some goods, so as soon as you deliver the goods, your performance obligation is met and you can recognize the revenue. And period of time means that there are some performance obligations which could not be met in a specific point in time, but they are met over a period of time, like service warranty services, like insurance contracts, rental contracts, or anything else which needs some time period to complete. So those performance obligations should be recognized over a period of time. For example, we just gave that one example that we sold one car for $30,000. And we know that within $30,000, $27,000 was for the vehicle and $3,000 was for the service. So total price of the car was 30,000, but it includes the vehicle and it includes 3 years of service. Okay. So what you need to do, that this 27,000, which is for the vehicle, as soon as you make the delivery, this you can recognize as your revenue, but this you cannot. So let's suppose that we sold this car on 01/07 2019, and then we are preparing our financial statements on 31st 12 on 2019. So what double entries we should make? So let's suppose that on this date, when you sold the car, so first performance obligation was met, which was delivery of the car. So $27,000 of revenue you can recognize because car you have delivered. This performance obligation, which is point in time, it is met. But this performance obligation, it is for the next 3 years. It is about period of time. You cannot recognize this one as revenue as of today when you sold the car. It is the day one. You have not provided any service, so you cannot recognize this revenue. So your double entries on 1st of July should be, debit cash, which you have received, say, I don't know, 30,000, because the customer might have paid you the cash. Credit revenue, and you take in revenue 27,000, and then you say credit deferred revenue. This is the advanced revenue, the deferred revenue, which you have received for the next 3 years of service. So $3,000 you have received, but you have received it for the next 3-year period. So on 1st of July, your double entry should look like this. And then of course, your year is ending. Let's suppose that your year ending is 31st December. So 6 months have passed: July, August, September, October, November, December, and you are allowed to recognize the service revenue for these 6 months. 6 months of service has already been provided, period of time. So 6 months revenue, service revenue, can be recognized. When I put it here in deferred revenue, actually, if you notice, I only put 27 in the revenue there. And this 3,000 is deferred revenue. Deferred revenue is a liability. Deferred revenue means prepaid revenue, advance income. You call it prepaid income, advance income, deferred revenue. It is all the same. And that is actually a liability thing. So this is my liability of 3,000. So on 31st December, when 6 months have passed, I can see that 3-year service contract, 3,000. It means 1 year of service is 1,000. And if 1 year is 1,000, then 6 months are $500. So I would say debit deferred revenue by 500. So I am actually decreasing my liability by 500, and I would make a credit to the revenue, and I would say credit revenue 500. And then when you will go on 31st of December 2020, when 1 year will finish, you will record another 1 year of revenue, which will be 1,000 here and 1,000 here. And of course, in 6 months, this is 1 year, 12 months. So a year and a half, you have already recorded in revenue. And then the remaining you will record in 31st December 2021. And then, 30th of June 2022, $500. So this is how you will recognize the revenue. So like we said that as the performance obligations are met. So this performance obligation was immediately met. So we immediately recorded the revenue. This performance obligation you are meeting over a period of time. So as the period of time is passing on, we are recognizing this revenue. So 5 steps we said. Number 1, identify the contract value. Number 2, number 3 was identify the performance obligation. Number 4 was assign value to each performance obligation. And number 5 was recognize the revenue. This is step number 5. So first thing you should be very careful about what are the 5, how to say, steps given by IFRS 15. Number 2, they may ask you, or you may be required to know very clearly recognition criteria. So I have got a separate video on this on your course page, recognition criteria under IFRS 15, that what conditions should be met before you can consider it as your revenue. So you have transferred the risks and rewards of ownership, and economic benefit has come in, and whatever recognition criteria I have mentioned there. One very important thing within recognition criteria is you should recognize the revenue, and of course, if it is a credit sale and receivable, if the customer has capacity to pay and willingness to pay. This is, among all other criterias, this is one which is a little bit delicate, and sometimes they try to twist the sentence. So customer has capacity to pay and willingness to pay. These are very important. This is, among other criterias which you would watch in the lecture, pay attention to this one, because sometimes students do not, pay attention to this thing, willingness. Okay, willingness, like this. So customer, and how do you find out the willingness or the capacity? In your exam scenario question, they must be giving a sentence. If they are touching this point, they would give like this, that based on the past experience, Alpha company knows that the customer always pays in the past, or the customer has a good track record of payment, or the customer has good financial history. This type of sentence they put in, and you understand the customer has ability or willingness to pay. Or sometime if they say that, there are some doubts about the customer's ability to pay, his financial position or capacity is under doubt, then you know that, okay, this is a problem area. So this is one thing you should be paying attention. I'm making a quick recap because you guys have already watched a 90-minute lectures, actually 1 hour and 56, almost 2 hours of lecture on IFRS 15. I'm just today making a quick recap. Number 3, which you should be very much competent, would be discount allocation. Discount allocation, how to allocate the discount between different performance obligations. Different performance obligations, I will show you on this thing now. Number 4, you should be comfortable with finance component, calculating the finance component. And I'm going to actually cover all of these one by one. And number 5, you should also be comfortable with variable consideration element. And let me now handle all of these 3 points one by one: discount allocation, variable consideration, and finance component. So first we talk about discount allocation in IFRS 15. Let's suppose that they tell you that we sell some equipment. Okay. Equipment cost, if somebody buys equipment as standalone, standalone means only equipment. Equipment costs something like, I don't know, let's call it 30,000. Okay. And if somebody needs 3 years of 1 year service contract for the certain equipment is, let's suppose, 1,500. This is the general terms. That if somebody comes to us and says that I want to buy equipment, and we say, okay, it is for 30,000, and then they say 1 year service contract is 1,500. In this particular case, but the customer, we agree with them that what we did, we actually sold the equipment with 3 year service. Okay. So we sold the equipment with 3 year service and we did it only for 30,000. So it's very obvious that we have given some serious discount to the customer, because generally it is 1,500 for year 1, 1,500 for the second year, and 1,500 for the third year. So if we consider the value of this deal or the value of this transaction should have been 34,500. Okay. So it should have been 34,500. But because of some circumstances, because of some relationship with customer, because of some bargaining conditions, we agreed a price 30,000. So clearly there is a discount. And how much discount is there? The discount is 4,500 in the deal. The discount is 4,500. The question comes in, this 4,500 should be subtracted from the price of the equipment, or should be subtracted from the service contract? The answer is that we should subtract it proportionately. We should consider that how much percentage we are giving discount. So if you consider that, you've got prices 34,500, you gave 4,500. So what is your percentage of discount? So I will just divide this with this. Okay. And I can actually multiply it with 100 also. So you are actually giving 13% discount. If you consider that you are giving 13% discount. So it means that on this 30,000, 30%. So this vehicle price, I just wrote it before like this. Okay. Now I'm just removing these numbers because before I just supposed these numbers. Now I'm going to convert them. So vehicle price, general price was 30,000. Service 3 years should be 4,500. And we should be applying 13% here and 13% here. So if I take this thing into -1, and so it looks like that this is the, I'm sorry, this is 4,500. So this is the discount which we are offering. So actually we are selling the vehicle. So vehicle standard price was 30,000. Okay. And service contract was 15, 15, 15. So it should make it 34,500. But we agreed on 30,000. So it means that 4,500 we are giving discount, which is 13% on the total value. So 13% I'm going to subtract from here. So it means that I actually sold vehicle not for, sorry, I need to plus it because I already put a negative. So vehicle is not sold for 30,000. Vehicle is sold for 26,100. And service contract is made for this amount. So you make a total, this is now coming at 30,000. There is some rounding off difference, okay? Because 13.04, I can take this number like this, okay? And also I can take it like this. And actually I should remove 100 from here. So it is 13 point something. Now if you see, I just made cell references. So now it is exactly 30,000. So 34,500 deal, you closed in 30,000. Within 30,000, the revenue allocated to the vehicle is 26087 and to the service is 3913. And now I would say that I received all of that cash 30,000. Out of that, the vehicle revenue should go to 26087 and the service revenue should be 3913 as my liability in the beginning. And then when I have to do for next 6 months, so it is like, 6 months of service revenue. How should I record 6 months of service revenue? I would just take this 3913 divided by 36, because 36 months multiplied by 6. So 652 I would be recording here. And then in this period, I would say 3913 divided by 36 multiplied by 12. 12 months of revenue I am recording here. Okay. So this is how we should be allocating. Now, before I just put numbers 27,000, etc. from the air, now I'm taking these numbers from this scenario. And the same double entry, you will record it for your third year, which is 2021. Okay. So 6 months of revenue, this is 6 months. This is 1 year. And the next is also 1 year. And now you have recorded 2.5 years. And the last entry will be 30th of June 2022. And this is your next 6 months. It's in the last 6 months. Okay. And last 6 months again with this number. And you put it here. And this way, you will, if you make a total of these numbers, it would give you 3913, which is that number. Okay. 3913. So you have actually recorded all of the revenue, but over a period of 3 years, 6 months in 2019, 1 year in 2020, 1 year in 2021, and 6 months in 2022. That's how you recorded all of your service revenue. So we learned here the period-based recognition and the discount allocation. You should remember that discount should be, first you find out what is your discount percentage, and then the same percentage you apply it to your individual performance obligations, and you find out the discounted price of each of the performance obligation. Then one step, okay, if you have any question until here, you ask me, or otherwise I will start explaining performance obligation. So you asked the question about customer has capacity to pay or willingness to pay. What do we do that? So practically speaking, let's suppose, and I'm actually talking about credit sales, because cash sales, I'm not concerned what is the customer's financial capacity or not. If somebody puts the money on the table, he puts cash on the table, I will sell the goods. I'm not concerned how much does he have in his bank. So we are particularly concerned about credit sales. So we know that on 1st of July, if somebody comes in, and if we know that they have a poor past payment record, we definitely will not sell them goods. Or not on credit. Or maybe a new customer comes in to your showroom and they want to purchase some goods, 10, 20, $30,000. And you don't know the customer and you don't know their paying capacity. Of course, you will not give them credit. So you don't give credit to the new customers without knowing their capacity. And you don't give credit to the old customers who have a bad payment record. So one thing is for clear, that on 1st of July, when we sell the goods, and when we sell the goods on credit, we are definitely very much sure that they have a capacity to pay, willingness to pay. So nothing will go wrong on 1st of July. 1st of July will be very smooth, because we only sold goods when we were sure that they will pay money in the future. The problem starts arising on 31st of December 2019, or maybe 31st of December 2020. Later on, the customer starts making delays in the payment. If that is the case, of course, you need to create allowance, you need to make bad debt or something else. Now, your question was, should we record the revenue or should we record the receivable or not? Now I'm going to speak a very practical aspect I want to see always. If you are the sales manager or you are the finance person, finance manager, and I am the shareholder, and you know that there is some money which is our receivable, and you know that this money is not going to be recovered, you know that you will not be able to take back this money from customer, are you going to tell me or are you going to show me this money in receivable? Should you show that money in receivable? Just ask yourself. If you know that,
No,
huh?
no, I don't think so.
That would be very much unfair. That this is what I'm saying, that you only record receivable when you know that it is going to come in. If you know that you have got $100 receivable, if you know that you have some, let me just write down, I'm just speaking very practical aspect, okay? So we are connecting it to our, how to say, true and fair view concept.
Yeah,
When you know that on your balance sheet there is a receivable of $100, but down deep in your heart you know that $10 you are going to lose, you know that there is going to be a bad debt of $10, should you show $100 on the balance sheet? No, you subtract $10 from allowances, bad debt, and you write on balance sheet 90. You will only come and tell me, I'm the shareholder, you are the manager. You will only tell me something which you can receive. Because if you tell me today 100, and then tomorrow I will say that, Kamlesh, go and bring me 100. And you say, you know what? I cannot bring 100 because $10 is under question mark. I said, okay, if it was under question mark, then why did you tell me 100? You should not have told me 100 in the first place. When you knew it at the time of preparing the financial statements on 31st December, that this $10 is probably going to go away, then you should have told me only 90 because I would make my plans according to 90. But if you give me a minute, I'll check my internet connection. Give me a minute, please. I'm
yes.
sharing it again. I'm sorry it was disconnected. So, but I will start recording from here. Okay, it is already recording actually. So idea was that you only extend the credit when you know that it is going to be paid back. And if on any particular date on 31st of December, if you realize that customer is not willing to pay, you just write it off. You do not show it. I mean, why should you be showing it if you believe that the money is not going to come in? So we just don't record the receivable. We just write it off. Next thing is about finance component. Okay, this is next thing, finance component. Now I'm going to how to say, uh, take the same numbers. I will take the same numbers. Okay, let's suppose that we create a scenario for finance component. This is again an important aspect in IFRS 15. Sold equipment for, let's suppose, dollar, you know, 30,000. Um, the customer would pay at the end of 2 years. Now, when you have a specific significant time period, we call it significant time period because you are selling goods here and the customer is going to make payment 30,000 here. And the question is that, is it the cash price of the good? Generally we know that cash price and credit price, there is always a difference. I mean, you cannot say that if my cash price is 30k, you pay me money after 2 years and still you pay 30k. So generally when you are given a credit facility, there is some interest cost, some finance cost inside of that. Okay, so it means that this 30,000 which I'm selling, this 30,000 is not the price of only equipment price, and it also has finance component. And we need to split it. This equipment cost, this should go to the revenue, and this finance component, it should go to my interest income, okay? Or you call it finance income. This should go to my interest income. This happens. Now, if a customer is paying in 2 or 3 months, then you don't do it. If it is 1 year and above, if it is 1 year and above, you must split this 30,000 into finance cost. And how do you do that? Generally, they tell us something like this. They use the word implicit rate of interest or interest rate, implicit interest rate is interest rate, I'm sorry, is 8%, or sometime they tell you that the company has cost of capital 8%, something like this. So it means that this 30,000 which I'm receiving after 2 years, this 30,000 which I'm going to receive at the end of 2 years, I actually need to discount it back here. Okay, I need to discount it to year zero. So how do we discount that? We know that discounting compounding. I will write down here the formula. A general formula, you would use it in many accounting and finance functions. Future value is equal to present value into 1 plus I, which means 1 plus interest rate. And you use here, power n, power n. And in this case, your future value is actually 30,000. Okay, future value is 30,000 is equal to present value you do not know. So 30,000 is after 2 years. How much is the present value? You must find that present value. And 1 plus 0.08 in our case, interest rate is 8%, and we say power 2. This is how you should discount it. And when I will find out present value, I would say like this. Okay, 30K. 30,000, I'm just okay, let me first write down the formula, and then I will put equals to sign, divided by 1 plus 0.08, and I'm using my discount rate, my discount factor as 8%, and time period is 2. And now if I put it here, it makes me like this, 25,000. So it means that the value of the vehicle, if you have 8% cost of capital, or 8% as your implicit interest rate, the value of the equipment was just 25,720. If you sell it on cash, the cash price of equipment is 25,720. The remaining difference between 30,000 and that is actually your, how to say, interest income. Let me show you the procedure. See here, I'll write it down again. I'll try to make it a bit more clear. This is my timeline. This is my year 1. This is year 2. And this is year 0. We receive 30,000 here. Okay. And what we do, that we discount this 30,000 here, and we find out the value 25,720. We have discounted it for 2-year period. Now, after discounting, what you need to do, because to the customer, you are not saying 25, to the customer, you are saying 30,000. Your receivable from the customer is 30,000, but to your revenue, this part should go to the revenue. And the difference is 4,280. This should go to my interest income, but it will not go into the interest income on day 1. It will go to the interest income during next 2-year period. So what we do, we unwind it. There is a word, we call it unwinding. Unwinding means when you are inflating it back. So I will unwind it, for example, 25,720. 25,720. I discounted it with 8%. I will unwind it with 1.08. I'm actually increasing the value. I will show you the numbers, and then I will unwind it again so that it becomes this number. How it will be done? Now let me show you the double entries. Okay. So let's suppose that we sold this thing on 01/01/2019. And on 01/01/2019, what I do, just remove this thing. sorry, I actually, okay. I get here 01/01/2019. So one entry, this is the day when I sold. Okay. When I say end of year one, end of year one. So in end of year one, I need to record my finance cost, my finance income or my interest income. Okay. So in the beginning, I would say debit my receivable. I'm telling to the customer that you have 30,000 payable to me, and I will consider it 30,000 and credit my revenue. And revenue, I will take only this one, 25,720. This is what is going to my revenue, 25,720, which is the, how to say, my equipment cost. Are we clear on that? Make it again. I just by chance deleted it. The scenario is that you are going to receive 30,000 here. What you did, you made it here 30,000. It became you 25,720, and you will inflate it over the end of year one. And how much it makes, let me just see the number, okay? And then I will write it down. 25,720 into 1.08, okay? How much it gives me? It gives me 27. Okay, let me just write down 8% into 8%. So I have got, okay, 25,720. Let me do it. I'm sorry. Let me do like this, 25,720. And here I put 8%. So it means that 25,720 into 8%. This is my interest income. Okay. And my total receivable, it becomes 27,777. And in the next year, again, I will take 8%, and this will make it like this. Okay. And when I make a total, it gives me like this number. It becomes 30,000. It becomes 30,000. Let me show you first the numbers. This is my interest income year one. This is my interest income year two. This is my receivable year one. Like what my balance is coming out as receivable year one. And this is my receivable year two. Okay. So you should actually not be recording 30,000 receivable on this day. This is very important to remember. Very important to remember. Otherwise you will get stuck. Because remember, when I gave to this customer this option that you purchase this good for 30,000, he comes to me and says, I want to pay after 2 years money. And naturally speaking, when somebody says, I want to pay after 2 years, they assume, and I assume, that it is not the cash price. Cash price is usually less. You always say, okay, what if I pay cash? How much do I have to pay now? You don't expect the same price if you pay today or you pay 3 years later. There's definitely some interest component into that. So when customer came in on 1st of January and you made a deal with him that I will give you this equipment, you will pay me after 2 years 30,000, and you agreed, you made invoice. Let's suppose 1 week later the customer comes in. 1 week later the customer comes in and customer says that, you know what, I requested a 2 year credit, but somehow I found some money, I found some cash, I got arranged it, I want to pay it now. Do you believe he will pay you 30,000, although he has got an invoice of 30,000 to be paid after 2 years? But if he comes after 1 week, or if you are the customer, should you be paying 30,000 in 1 week's time? Because you will believe that 30,000 I should be paying after 2 years. If I'm paying today, just after 1 year, I did not use this credit facility for 2 years. Why should I be paying 30,000? Does it make sense? Like sometime you close your credit with the bank before time. You take 1 year credit from a bank. But then after 1 month, you go to the bank and say, I want to close my deal before. I want to pay all of my credit now. And of course, the bank will decrease, it will take away the interest. So 30,000 you cannot record here now. In your receivable, it should not be 30,000. In your receivable, And by the way, you should always remember one key rule. Always remember, this is for sure. You will never forget whether it is interest expense or whether it is interest income. Interest is never recognized at the beginning of the period. Interest is always recognized at the end of the period. Interest is accrued at the end of the period. Bank, like if I go and take, if I take $10,000 from a bank, and banks and the bank says, okay, you will pay after 1 year 11,000. Okay, I'm taking 10,000 from the bank today, and the bank says, if you pay me after end at the end of the year, you will pay me 11K. I say, okay, fine, thank you, I agree. I take 10,000 and I agree to pay 11,000 at the end of the year. But if I go to the bank just next day or after 1 week and I say, I don't need the credit anymore, I want to close my credit, the bank will not ask me to pay 11,000, and I will also not pay 11,000. I would say I will only pay interest for 1 week, or probably there are some service charges I will pay, some transaction costs, some service charges, but 7 days of interest I would pay. Why should I pay 30 days of interest? I would not pay 12 months of interest. The same happens in this case. So when you sold the goods, initially the equipment value is 25,720 and your revenue is 25,720. You should not recognize 30,000 because customer does not owe you 30,000 on this date, my dear. On 1st of January, customer does not owe you 30,000 and you don't have a receivable of 30,000. 30,000 is a receivable at the end of 2 years, not at the beginning of 2 years. So in the beginning of the 2 years, I will put it as 25,720. Then end of 1 year, when 1 year has finished, I will now make this entry. I would call it debit receivable and credit my interest income. How much? This amount. This is first year interest 2058 and my interest income 2058, like this. And now if you see how much your receivable has become in your books, now receivable is 25,720 plus 20, which is 2778. If I make a total of these two numbers, it will give me 2778, which is the same here. Then end of second year, end of year 2, again I would pass on this double entry, and now this time the interest income is triple two, double two, and like this. Now if you see your how much is your receivable now, your receivable has, it was 25,720 plus 2058 plus triple two, double two. Now it is exactly 30,000. Your receivable has increased over the time. And here, when you have this receivable, now you call customer for payment. And the customer comes in and he gives you cash and you say, debit cash, 30,000, what he will pay you, or maybe bank, whatever, and credit receivable. And you write away your receivable like this. This is how it should be done. So what we understand that when we started this thing, because customer is going to pay us in this period of time, so 30,000 we are supposed to receive here, 25,720 is here. For year 1, my interest income is 2058 and my receivable balance, it becomes 27,778. Then in year 2, my interest income is double two and my receivable becomes 30,000. This process, when I made this one, this process is called discounting. And this process is called unwinding. You will call it unwinding. Unwinding means that when so this is the future value. I'm in discounting. What happens that future value I'm converting to present value. I'm sorry, I will make it like future value I'm converting to present value. Like 30,000, I made it to 25, discounting. In unwinding, what I'm doing, that present value, I'm making it equal to future value. So it is the opposite process. You can also call it compounding, by the way, unwinding or compounding. Are we clear on that?
It's okay, very clear.
Yes.
So you had a total invoice. So this treatment you will do if there is a time lapse of 1 year. If the customer is paying within 6 months, generally we do not do financing component. But yes, even if it is for 6 months, but the transaction is like for $30 million, it's a significant interest amount. Even if it is 6 months, I will do that. I will see the materiality of the transaction. I mean, if it is like 100K and the customer is paying in 3 months' time, no need to do that. You don't separate financing component. Generally, we separate financing component when the delay is 1 year delay. This is the general rule. However, we may do it for a period of less than 1 year if the amount is very significant, if the amount is very big. Clear? Any questions you want to ask, please ask. So you understand the only thing you need to remember that this part will go to income, okay? Interest income. Revenue was only 25,720. The remaining difference of 4,000, whatever it became, that goes into your interest income. And then you ask that if a customer make late payment, let's suppose that we agreed with customer that he would pay in 2 months, but then the customer sometime pays in 12 months. They don't make payment in time, they make delayed payment. So now this 10 months difference, what do we do with that? It depends on your arrangement or agreement with the customer. If the contract says that if you do not pay within 60 days, we would be charging 0.05% or 1%, whatever is written. So if you charge to the customer some interest as a result of late payment, and the customer has also agreed to pay that, in that case, that late payment charge will also go into the interest income. Your original invoice cost of the good or the revenue from the good of sale of good will not change. Anything which is additional coming in later on, that should go into the interest income. So this is
If
one more.
if we are, I have just one clarification. If we are not getting anything extra, so our revenue is go as it is. It will be
Yeah,
not not discounted or something. Nothing. Yeah.
yeah, as it is. If in the beginning you made an invoice of, $30,000 for 2 months, and then customer pays $30,000 in 12 months. So of course, this 30,000 you supposed to be, that was the price of the equipment. There was no financing component inside because you never knew that customer will pay in 12 months. If you had known that customer will pay after 12 months, probably you would have asked him 32,000. And then that 2,000 was the interest component. But in this case, in your best belief, you told him the cash price 30,000. And that's 2 months is just standard normal business credit. There is no interest added into the normal credit period. When we say that we sell goods on 30 days credit, 45 days credit, it is considered as the price of the good. We don't consider that interest is inside. Like most B2B selling, business to business selling is never on cash. It is always on credit, 30 days, 45 days, and 60 days. There is no finance component inside. Yes, finance component comes inside when the period becomes longer, like 12 months and so on. So if in this scenario, we agreed for 2 months and 30,000, customer paid in 12 months and 30,000. And by the way, if he pays in 12 months and if he pays in 30,000, you should be saying Shukr Allah, thanks God. Because
Yeah.
this is the time when you already have started feeling that I'm not going to get any money. So even if the customer is paying 29,000, many people would be happy actually. Do you understand my point?
Yes. Yes. Definitely clear. Yeah.
I mean, I'm speaking very much real.
Yeah. Practically, this only happens here.
Yeah. So then we did finance component. After finance component, there is something which is called variable consideration. Okay. This is also one important aspect of IFRS 15, which you should be capable of handling. We call it variable consideration.